Financial markets brace themselves to the report of crucial importance, the US inflation data. Analysts predict new highs in consumer prices, which justifies aggressive monetary tightening by the US Fed. Under such conditions, the US dollar index has settled firmly at the highest levels in 20 years, as investors are attracted to the safety of the US currency. What other events could influence market sentiment in the second half of the week? Let's watch a regular video calendar on InstaForex TV channel. If investors are poised to buy safe haven assets, it means they sell risky assets in parallel, including the Australian dollar. On Thursday morning, traders will be able to evaluate the conditions in the Australian labour market. The consensus suggests upbeat employment data, which could lend a helping hand to the Australian dollar. Some recent reports logged stronger than expected data. It might also happen that the data, which is due on July 14th, will be better than predicted. Like the Federal Reserve, the Australian Central Bank assesses the conditions in the labour market as a barometer to judge whether the economy is ready for a rate hike. Thus, a decline in the jobless rate and employment growth will assure the regulator to raise interest rates by 50 basis points at the nearest policy meeting. After the US CPI data released today, investors will be able to reckon the prospects of further changes in consumer prices. On Thursday, the US will report on its factory inflation for June. The forecast is gloomy, as producer prices that have already settled at the elevated levels are extending their rapid climb. Fast factory inflation is also bullish for the US dollar. The Federal Reserve has pinpointed high inflation as the main evil. So they are committed to struggling against inflation through a series of fast rate hikes, even despite recession risks. Notably, the term of a recession is frequently used by experts in recent forecasts in the global economy. On early Friday, market participants will get to know the GDP rate in China's economy. To be exact, analysts warn about a contraction in China's national output. The second global economy is expected to shrink 1.5% in the second quarter sequentially, thus pushing an annual GDP rate down to 1%. China's GDP growth declined for the obvious reason that Beijing imposed COVID restrictions, including a shutdown at industrial facilities. Nevertheless, the industrial production data for June could indicate that the industrial activity was gaining momentum. According to flash estimates, the industrial output could have rebounded significantly to 4.1% on year from 0.7% in the previous month. No wonder such positive metrics will boost demand for the Australian dollar, as the currency of the country that supplies the lion's share of commodities to China. Apart from that, market participants will take notice of trends in the US industrial production. Analysts foresee an uptick of 0.1% in the industrial output in June, the same rate as in May. The annual rate is expected to slow down to 4.8%. Importantly, two-thirds of the total US GDP are generated by consumer spending, not industrial production. Hence, investors will be mindful of other economic data released on Friday. Retail sales data is certainly of high priority for investors. Analysts reckon that consumer activity was robust in June, and retail sales increased by 0.8%. Even though the annual rate should have eased last month, investors are likely to focus on the upside. All in all, they will go ahead with the speculations on further aggressive monetary tightening by the Federal Reserve. Such events are going to influence the trends of the second half of the week. Follow our daily news reports. See you!